Hi, Happy New Year to our listeners and viewers. Welcome back to the Professional Investment Podcast for the second series. Each episode, we welcome a guest to the show to share their news story of the week. And I'm delighted to welcome Keith Guthrie, Head of Sustainability at Cardano UK and Now Pensions for the first episode of the second series. We're both especially delighted to be on the show because we've had all kinds of technical difficulties, so you should feel especially privileged. Welcome, Keith.
Thank you so much, Charlotte. It's great to be on the show.
Lovely to have you. Really lovely to have you, given all the hassle we've gone through for the last half hour. But now that you're here, please do tell us, what is your news story of the week?
So I thought we'd focus on the story in the FT on the 10th of January about the fact that the world has now passed a 1.5 degree global warming target for the first time last year, 2024.
And do tell us, what is it about that story that caught your attention? Why did you want to make it your news story of the week?
So, of course, focusing on sustainability, we all have committed to the Paris Agreement, where the target was trying to limit global warming to 1.5 degrees or less by 2100. And we're 75 years ahead of that date, and we've already surpassed 1.5 degrees over pre-industrial levels for the first time. And of course, 1 year of surpassing that doesn't make it permanently surpassed, but unfortunately the trend is now looking very inevitable. And I think that it's quite likely that 2024 will be one of the coolest years of the next 75 years. So, the implications of this are really far-reaching. It seems to me now that it's very unlikely we will limit global warming to 1.5 degrees. It's far more likely we'll get to 2 degrees or even worse than that. We had commitments to try and limit global emissions by 2030 or halve global emissions by 2030. That was the hope at the beginning of the decade. Global emissions are still at all-time highs last year. And you're starting to see the human and the economic costs of this in very real reality, in live as we speak, with the LA fires going on as we speak, with the loss of life. 220 people died in the floods in Valencia just a couple of months ago, in the floods here in the UK. It's all really coming home to roost, unfortunately.
Yeah, so as you say, the economic costs of climate change are really become real. I mean, in that climate section of the FT, there was another particularly standout headline where it said the cost of catastrophe insurance had risen by 30% in 2024 alone from the year before. So you're saying a third of an increase, almost increased by 33% from 1 year to the next. Yeah, we've got disco lights there, haven't we, Keith? We have to keep moving to keep the lights on. But yes, it's all a bit doom and gloom. So yeah, we are seeing those economic costs come through, and that's ongoing. So we're getting parts of the world, even the developed world, as we've seen with California and Florida, which are uninsurable. What are the implications of this acceleration to climate change for large professional investors? How do they cope with this, the fact that things seem to be going faster than we anticipated?
So I think, first of all, the reality of the economic costs is now becoming much clearer. And as you just sort of think through the implications for people who own properties, many people have their store of wealth, their primary asset is their home. And when that home becomes uninsurable, as we're seeing in California at the moment and in the UK and in Spain, the value of those, you can no longer get a mortgage on those homes. Suddenly you will no longer be able to afford to sell that home to someone else who can't get a mortgage, and the value of that property can really plummet. So the economic implications and the costs start to roll up. I think we mentioned the states as the insurer of last resort in these cases. And if these kind of costs fall on the states, their credit risks will also become more and more questionable over time. So I think you'll start seeing the sort of real market type of impacts of these developments much sooner perhaps than people had previously anticipated when they thought this was still many, many years away. And if this is what's happening at 1.5 degrees, the real challenge is that we will continue to see warming over the coming years while we are above net zero. It's not good enough just to start reducing emissions. We actually have to get those emissions to net zero to stabilize the system. So what we're seeing right now is only just the beginning.
And so you're talking there about, obviously one particular sector, because we mentioned the insurance and talking about people housing, and obviously the economic ramifications are much broader than that. I mean, it's going to affect every aspect of our life, and therefore every aspect of a large professional investor's portfolio. How do those investors take into account the kind of the risks, the asset allocation, and the stewardship implications of these accelerating change? What do they need to do differently or more quickly than they were thinking about doing?
Yeah. And so you mentioned three different areas there, risk, asset allocation, and stewardship. And I think each of those are important and probably have slightly different implications as we try and tackle what we're seeing here. But it does require us to adapt. So I'll maybe address each of those in turn. So to start off on the risk management side, I think that many of us have been focused on the risks of transition happening more quickly than we anticipated, and that's not happening. That doesn't mean that transition risk has gone away. It will certainly still, in fact, it may even increase over time because it may become a more chaotic transition. But I think the area that it really highlights that's going to become more important in our assessments of risk is physical risk. And to understand the physical risks of the investment you're invested in is actually a really tricky exercise, because you need to know exactly where each company has all of its assets, and not only that company's assets, but also its supply chain and where its assets are located. And the impacts of climate change, as we can see, are very different depending on exactly where you're located in the world. So getting access to that kind of data, I think from a risk management perspective, is one of the key challenges. The second area you spoke about was asset allocation. And I think the big question we have to be asking ourselves there is whether we're targeting the right objective. So many of our clients have set objectives where they're aiming to decarbonize their portfolios 50% by 2030. And we're clearly out of step with that in the real world. The real world is not decarbonizing that quickly. So the real question is our objective the right objective? And I think there's probably been too much focus on headline carbon metrics. And where we need to really focus our attention is on the transition plans of the underlying companies that we own. And are they putting in place transition plans that will actually get them to net zero by 2050? I think, the hopes of halving it by 2030 are increasingly desperate. But really focusing on the underlying companies much more than the headline carbon metrics, and focusing on the transition plans that those companies have. So I think that's one thing we can do on asset allocation. The second is probably looking more at climate mitigation. So what sort of investments might actually do better in a world where we're not going to be limited to 1.5 degrees, but maybe more towards the 2 degrees? And by that, I don't mean investing more in oil and gas stocks because we're getting to 2 degrees. I mean investing in the kind of companies that might actually benefit as we try and put more things in place to prevent some of the effects of that. And that might be more infrastructure that might be needed in an environment where these climate change risks are more extreme, or nature-based solutions. I think there are a whole lot of things that we need to think of from the asset allocation area. And then if I may, the third area that you mentioned was stewardship. And I think that's where the objective doesn't change. And really, the objective of our stewardship needs to focus on the transitions in these underlying companies. And I think that's really important. These days, there's a bit of a bifurcation within the industry of some asset managers saying, well, it's really up to management to decide how quickly they wanted to transition and how they're going to adapt to this. And other investors saying, no, the systemic risk of climate change is really what's important. And we need to have companies develop transition plans. And I think we're very much in that camp. Companies need transition plans in line with science-based targets that are appropriate for their particular sector or region that they're operating in, but they need to be developing those transition plans in order to reduce their carbon emissions if we're going to have any hope of slowing down the rate of temperature increase.
I'm struck by your very well reasoned and detailed answer there about just how much pressure we're actually putting on investors. And I'm also struck by the kind of the dichotomy of all these disasters, with everything that's going on in Southern California at the moment, and really that fire catastrophe being just so appalling and so much worse than anybody had anticipated, that you've got this odd dichotomy where you've got Trump coming in as the new president, and yet this kind of pullback from climate change just as climate change really makes itself felt. And I wonder if, that's going to put even more pressure on financial institutions like professional investors to do more of the heavy lifting, because it doesn't look like we're going to get anything like the global policy that we need to really have the government support to make these changes. Is that something that investors need to think about? Are they going to have to do even more than they thought they were going to do?
So I think this is a tricky one, because we are going to see divergence in global policy across different regions. And we're already seeing many more companies starting to pull back from previous commitments that they've made. I think we need to face the reality that that is the moment we're in at this point in time. I think in the long term, it is inevitable that these things will come back onto the table. What we're seeing right now is going to continue to impact voters. It's going to continue to become a bigger and bigger issue for people over time. That is an inevitability. So the policy response, I think, will come over time. And I don't think that financial investors can achieve this whole transition simply on their own. Now, there are things that will help us. So economics will work in our favor as, for example, renewables continue to get cheaper and cheaper. They will become more cost effective than relying on fossil fuels. But the transition towards a more renewable economy is still going to depend on regulation. And so I think the part of what we have to start thinking about here, certainly for investors who are committed to trying to make a difference to climate change, is to think more about systemic stewardship, to think about how do I influence this whole system? And that has got part of the answer has to be regulation. So how do I affect regulators? And just to pick a simple example, if we want regulation that encourages us to use more electricity rather than fossil fuels, we need to make sure that taxation of electricity and the sort of the costs that are loaded onto electricity are not higher than on natural gas, which is the alternative that many people are using to heat their homes or to generate electricity. And I think that you see many of these examples where policy is not well aligned to create the right incentives to cause consumers to shift. And it's only as the economics really starts to align for them. It's still much cheaper for me to heat my house with gas than it is with electricity, and therefore the incentive is not there properly. So we need regulators to help out with that. We need the right kind of taxation, the right kind of incentivization. And as investors, I think the approach we have to start thinking much more of is how do we engage with governments to try and achieve that effectively? Because I think companies are very used to lobbying. Big industry is very used to lobbying for its own sort of like special, treatment, and government need to be hearing an alternative narrative. And for our members in the long term who are going to be very affected by climate change, it's a systemic issue that will mean that the whole value of all of their assets is impacted. As we were saying, if you've got both governments that are affected because they're the insurer of last resort, and you've got a wealth destruction of the consumer's assets, there's no place to hide in your portfolio construction. It really has to come through this collective work of both government and investors working together. So I think we need to get better at engaging with governments to create policy change.
I mean, I must admit, systemic stewardship might feel like just another piece of financial industry jargon, but I do welcome the fact that the industry seems to have woken up to the power that it has. I mean, the UK, I think, is the second largest number of pension assets after the US in the world, and that is a lot of assets and a lot of, you represent the interest of a lot of those citizens of the country. There is a great campaigning opportunity that I feel the industry hasn't ever grasped, because it's not very comfortable campaigning. It's still kind of smarting maybe from the 2008 global financial crisis, and also putting its head above the parapet whenever it dared, with the EU referendum and trying to fight for what it needed there. So there is a sense that the industry does need to sort of gather its courage and use its power that it actually has to try and make positive change. So I do welcome that. And I think that can be done maybe individually within individual countries to begin with, and then maybe collectively at a larger scale too, which is sort of runs counter to the trend that we see at the moment, where people seem to be pulling out of things like Climate Action 100 Plus and other, collective organizations to affect climate change. So yeah, there's definitely work to be done there, isn't there?
Yeah, I think that a lot of this comes down to an interpretation of fiduciary duty. And I see some investors arguing against the idea that investors should be somehow responsible for systemically engaging with governments. It's not their natural skill set. But I think that that's a bit of a historical perspective on where we've come from. And the real challenge, I think, that you have when you say, well, my fiduciary duty is only to maximize the value of each individual asset that I have, is that it's then very much in your interest to argue that, an oil and gas company should be continued to allow to lobby to maximize its shareholder value. And that's really not looking at the portfolio as a whole. It's looking at the individual asset. And I think that when you start looking at the portfolio as a whole, you have this real tragedy of the commons, where what is good for each individual asset is not what is good for the portfolio as a whole. What's good for the portfolio as a whole is very clearly attempting to transition as quickly as possible. And so I think what would be really helpful in the industry is if we could start having clearer statements from asset managers as to exactly what it is that their objective is with their stewardship. And some may well say, listen, we're out there to maximize the value of each individual asset one at a time, and we don't think we should be thinking about the system as a whole. And I think you'll see others saying, well, we do think that the systemic approach is the correct approach to be taking. And I'd really welcome more differentiation there, because I think that would allow asset owners to decide where they stand on this and to align their selection of asset managers with the objectives of the stewardship. And I think that sort of choosing your asset manager based on what their objectives of their stewardship are is going to become a much more important criteria when choosing asset managers in future.
Yes, I agree with that. And I think that's going to be very interesting to watch unfold over the next sort of 5 years or so. And something that strikes me from what you're saying, I think this is particularly important for the sector that we're talking about, for these professional investors, for the large pension schemes and insurers, because we're talking about multi-decade investment horizons. And so when you're thinking about fiduciary duty, if you're thinking about your fiduciary duty to your scheme members, you don't want, as Mark Fawcett once said, you don't want your scheme member to retire to a planet burnt to the cinder, and you're like, how am I even going to survive, and where am I going to get my water from? So there is that, I think, that more holistic definition of fiduciary duty that maybe, and I think that's, to be fair to the UK pensions industry, I think that's fairly well embedded here. Maybe not in other parts of the world, but that people have that sense of, I do need to make sure that my members can have a comfortable retirement, and that does mean making sure that the planet is still habitable and that society is what we want it to be, and it's not a dystopian nightmare. I want to pick up on something you were, in your very detailed answer to my question, you mentioned that the thing, if we're talking about risk, managers are going to have to start delving down into the detail of each company and see where all their assets are and start assessing those risks. And then you also mentioned that when it comes to asset allocation, they're going to have to start thinking about how those companies are transitioning if they're doing it effectively. And that obviously leads through to their stewardship program. I wonder if we could talk in a bit more detail about the pressure, the political pressures that we have as asset managers when it comes to questioning, for example, we saw BP and Shell, after a lot of pressure, adopt net zero targets, but there's a lot of question in the industry if those targets are ever going to be realized, if that's going to happen. There is this question about, are those companies going to reinvent themselves as new green energy companies, or are they just going to go bust in the way that IT companies, their technology becomes obsolete? Is there more political pressure on people like you who are advising clients to maybe start divesting for some of those companies, or have we not given it long enough? Do we need to try a bit harder? Can you talk about those kind of pressures on where we are on that divestment engagement journey?
I think this is one of the trickiest bits to get right, and to be clear, I think that with a lot of the clients that we advise, and for example now pensions that I'm head of sustainability for, we've already advanced quite a far way along that journey. So let me describe a little bit about how we think about the market. I'd say that we'd say 35% of the market is probably contributing to the transition or already operating sustainably. About 45% of the market is what we would describe as adapting, or has the potential to adapt, and we think is willing to adapt. And we'd really love to see those transition plans get more concrete. They don't need to be perfect right now, but they need to be working on them. And we really think that they're on a journey to which has a reasonable endpoint. It's the last 20% of the market that we really struggle much more with, and where in many cases we've already decided that we will no longer invest with them, because having engaged, it's either clear that they are not willing to be adapting to the transition that is needed, or maybe they even say that they are, but their actions clearly demonstrate that they're not. There's substantial risks that they will fail to transition. And when we think about our stewardship, where we want to exercise our resources, they are limited. We want to be engaging with companies where we think we will get change. And we know that in some cases, we're just not going to convince these companies to change. So again, I think what we're trying to do is we are walking along that line of saying, well, there's a decent portion that we are now already deciding to exclude. Other investors exclude far less and say, well, we want to be much closer to the benchmark. And that's, I think, one of the choices that investors really have to make here. And then on the other hand, what can we do about those companies? I think maybe we can do some systemic engagement with governments about how to make sure that those companies are required to do some sort of transition. But whether governments get there or not, I'm not quite sure. I think the big challenge is one of time frame. So coming back to your point on fiduciary duty, when you've got some investors who are like by 2050 or 2060, we know that these climate change effects are going to get very much bigger than they are already. And so we know that that's in their interest to decarbonize as quickly as possible. When you look over a 5-year time frame and you say, well, what's in the right interest of my members right now? We really struggle with this question, because while we have disinvested from many of the companies, for example, in the oil and gas sector, we haven't disinvested from all of them. We don't think that the ones we still own have credible transition plans. We've really been trying to engage with them, but we're not making much progress. And so there's this real tension of, do we disinvest completely, but at the same time, the financial risk of doing that, because the world has not transitioned and is not already at a point of saying we don't need fossil fuels anymore. I mean, the end problem is we demand fossil fuels. As consumers, we are still using them tremendously, and so in the end, it comes down to our own actions that we haven't yet progressed to a point where we're saying we're prepared to live in a world that is not using fossil fuels. And so I think there's this real balancing act that we try to get right with our clients of saying, well, we think you should be disinvested from a lot of these, but not all of them right now. And that will probably change over the next 5 to 7 years. But a lot of that does depend on the pace of change in regulation and how quickly we see the world beginning to change.
Yeah, and I mean, I'm struck that this is kind of the same conundrum that we always have in investment, right? That I experienced when I was an investment analyst, in that what you think is going to unfold over the long term is probably going to happen. But in the meantime, if you get the short term wrong, people tend to get very cross with you. And we've seen that over the course of 2024, where people really rolled back from ESG tilted indices and got very worried about aggressively built indices that excluded a lot of companies, and moved back towards, we've seen a massive inflows into just very traditional S&P 500 indices. And so there is this kind of constant pull between, do I want to take a stance that will be good for the long term, and can I afford to sacrifice the short term? Or am I going to be, burnt at the stake if I do that? Not to use a heat metaphor, but, that is a constant pressure, I think, on investors. And I think you do have to sort of walk a bit of a tightrope over that, because you will be chastised if you sacrifice a lot of return over the short term.
And I think that comes also to understanding each investor's beliefs and preferences. And we generally do see very different beliefs across our client base. So we have some clients who are quite clear that the tracking error versus the main market is important to them, and we need to manage that and not allow that to go to extreme. And we do have other investors who say, no, the sustainability angle, the fact that I want to only be in companies that are already transitioning and are supporting this transition, that's the most important piece. And that's the piece that I want to focus on. So I want you to take, an even more extreme position in the portfolio. And so I think it is a case of, investors, asset owners being clear in their own beliefs and how far they're willing to back them. If you are saying, well, I really want to be invested only in transition, I think you do need to accept that you're going to perform differently from the indices. But then, other investors are not prepared to move there yet. So I can see it's the legitimate arguments on where you land.
Mm. And so you mentioned, obviously you're head of sustainability for Now Pension. So if you were to put aside your Cardano UK hat and put that hat on, what you described in terms of, the assessment of the risk and the asset allocation process and the stewardship process, is that a blueprint for what you are trying to implement at Now Pensions as head of sustainability, or is there anything you can add to that?
Yeah, so very much. The trustees are very focused on risk return and real world impact. So they're trying to navigate both of those objectives. Their key themes are climate, living wage, and gender equality. And so those are the particular areas that they want us to focus our stewardship efforts on. And so climate is a very important component of that. And the strategy we're implementing there is very much in line with the one I was describing earlier on. So we've excluded around about 18% of the global equity market. We're not completely out of fossil fuels, but the ones that we do own, the limited number we still do own, we're underweight the sector, and they're the ones that we think have the most potential to transition. And all of those aspects sort of come into that, attempting to both invest to achieve market-related rates of return, and walk that tightrope of how far we are. And I think there are many where we just feel like the risk of investing with them and the impact that they're having on the real world is just too negative to be invested. Beyond the equities, and we apply that, by the way, to both equities and the credit strategy, within the portfolio, there's also some green bond investing, where we're aiming to directly impact solutions to try and move forward investment in renewables, in energy efficiency, and those sorts of things that are being financed by those green bonds. And then I think there are a number of areas where we've still got to figure out what the next steps are for us. And so, coming back to some of those things I mentioned earlier on, I think we're still at the discovery stages when it comes to improving our data on the physical risks. We really want to be doing a lot more on that over the years to come and understand our portfolio risks much more from that perspective. And then things like, are there things we can do on the climate mitigation side? Those are things we're very much exploring at the moment, probably as part of our growing illiquid allocations.
Okay, well, I think that's a great place for us to end the first episode of the new series. I want to say thank you so much, Keith, for sharing your news story of the week. I know it was somewhat depressing, but I think we've had a really good and detailed discussion on what professional investors need to step up to the plate and deal with all of these issues that are being created by an acceleration in climate change. Listeners, welcome back. Thank you for tuning in again. If you want to make sure that you never miss an episode of the second series, and make sure you hit the subscribe button. We'd love to have more engagement from you this series, so please feel free to leave a comment below, and we're also going to add a poll on Spotify, which we hope you'll engage with. Thank you again, Keith, and thank you to all of you for listening.
Thank you, Charlotte.